The way we shop online is about to change, fundamentally. For years, e-commerce has been built on the same basic model: search boxes, product grids, checkout pages. It works, but it's clunky. Consumers still abandon carts at alarming rates. Retailers still struggle to convert traffic into sales. Now, a new wave of artificial intelligence is entering the equation. Not chatbots that answer basic questions, but AI systems capable of understanding intent, guiding decisions, and completing transactions seamlessly. That's what we're looking at today. The company is called Rezolve AI, ticker RZLV, listed on the NASDAQ. And before we go any further, let me be clear. This is not financial advice. This is educational content. I'm not telling you to buy or sell anything. I'm breaking down a company so you can understand what it does, where it stands financially, and why it's getting attention right now. If that sounds useful to you, stick around. And if you find value in this kind of analysis, a like or a subscribe helps more than you know. Let's get into it. So, Rezolve AI. What do they actually do? Think of it this way. When you go to a big retail website, let's say a fashion brand, and you type blue sneakers, you get hundreds of results. You scroll, you filter, you compare, you get distracted. Maybe you leave the site entirely. Rezolve is building AI that changes that. Their main product is called Brain Suite. It includes three components: Brain Commerce, Brain Checkout, and Brain Assistant. Together, they create what the company calls Agentic Commerce. Now, what does that mean in plain English? It means an AI that doesn't just help you search. It actually handles the transaction. It understands what you want, finds it, and can take you straight to checkout, like having a personal shopping assistant that actually knows what it's doing. That's the pitch. And it's not just a prototype. They're already deployed with major retailers, and names like H&M and Urban Outfitters have been mentioned in their announcements. Now let's talk numbers, because a good idea is one thing. Execution is another. As of today, February 4th, 2026, the stock is trading around $2.40, down about 7.7% on the day. The 52-week range, that's important. Low, $1.07. High, $8.45. So right now, we're much closer to the bottom of that range than the top. The market cap sits around $800 million. So this is not a micro cap, but it's not a mega cap either. It's in that mid-tier space where institutional investors are watching, but retail still has access. Now, revenue. For 2025, the company guided around $40 million in revenue. For 2026, they're projecting $350 million. Yes, you heard that right. That's nearly a 9 times jump in 1 year. And their annual recurring revenue target? $500 million ARR by the end of 2026. If you're new to this, ARR stands for Annual Recurring Revenue. It's the money a company expects to receive every year from subscriptions or ongoing contracts. It's a key metric for SaaS businesses because it shows stability. Now, here's what's interesting. Their gross margin, the percentage of revenue left after direct costs, is reported at 95.8%. That's exceptionally high. For context, most software companies aim for 70 to 80%. A 95% margin means almost all of their revenue turns into gross profit. But, and this is important, the company is not yet profitable. They're still operating at a loss. Their adjusted EBITDA is negative. That's normal for a growth stage tech company reinvesting heavily, but it's something to understand. Let's look at what's been happening recently. On January 21st, 2026, Rezolve announced the closing of a $250 million funding round. That's significant. It gives them the runway to expand globally and continue deploying their AI platform with large enterprise clients. They also have a strategic partnership with Microsoft Azure, which is a big deal in terms of distribution. Azure is one of the largest cloud platforms in the world. Being integrated there opens doors. Analyst coverage? Right now, the consensus is a strong buy, with price targets ranging from $11 to $15. Now, let me be careful here. Analyst targets are not guarantees. They're estimates based on models and assumptions. The market doesn't always agree with analysts, and price targets can change. But what it tells us is that some professionals are paying attention, and they see a gap between where the stock is today and where they believe the fundamentals could take it. Let's not ignore the other side. This stock is volatile. On January 20th alone, it dropped 23% in a single session before stabilizing. That kind of movement can be painful if you're not prepared for it. The company is also not profitable yet. They're burning cash to grow. That's fine, as long as the growth materializes. If it doesn't, the math changes fast. And finally, the execution risk. Projecting $350 million in revenue is ambitious. Very ambitious. If they miss that target significantly, the market will react. So if you're looking at this, you need to understand this is not a stable dividend-paying utility stock. This is a growth bet with all the upside and downside that comes with that. So why does this company get attention? A few reasons. First, the market they're targeting. E-commerce infrastructure is massive. Trillions of dollars flow through online retail every year. Second, AI and commerce is still early. Most retailers are still using basic search and checkout systems. If Rezolve's technology actually delivers better conversion rates, the demand could be significant. Third, the financials are unusual. A 95% gross margin with aggressive revenue guidance is not common. If they hit even a fraction of their targets, the valuation math could shift. And fourth, institutional validation. The Microsoft partnership, the $250 million raise, the analyst coverage. These are signals that serious players are involved. None of this is a guarantee, but it explains why the stock is on watch lists. All right, let's wrap this up. Rezolve AI is a company building AI-powered commerce infrastructure. They're targeting a massive market. They have high margins, and they've raised significant capital to execute. But they're also unprofitable, highly volatile, and their projections are aggressive. This is not a recommendation. This is an analysis. If this kind of company interests you, the next step is your own research. Read their filings, understand the risks, decide if it fits your strategy. As always, this is educational content, not financial advice. If you found this breakdown useful, consider subscribing. I'll keep bringing you these kinds of deep dives on companies that deserve to be understood, not just hyped. Thanks for watching. See you in the next one.